about the chat protocol when that happens, when we get to it. Well, welcome everyone to the Managing Cash Flow webinar. Really, the idea is to help you make smarter financial decision making using cash flow forecasting, and that's what today's workshop is about. We're going to start as we normally do. Oh, sorry, I got for some reason. There we go. There we go. With introductions, and I think most folks have heard us say who we are and what we're about. So maybe Julie will do it quickly. But I'll have you start with talking about yourself and the New Hampshire Community Loan Fund.
Sure.
Go ahead. I'll let you jump in.
Thanks. Hi, everyone. This is Julie McConnell. And for those of you that don't know me, most of you do, I manage our childcare loan program here at the Community Loan Fund. And as part of that program, we have developed the Business of Childcare Initiative with grant funding from a number of supporters. We've been doing this for a couple of years now. And Kim Vada is our project consultant, and we've designed this hopefully to deliver to you what you need in terms of business support for your programs, both in terms of this kind of workshop, and then we have developed TA opportunities and some grant funding for folks that are in specific regions of the state where we have the grant funding available in the Upper Valley and in the Southern Manchester, Nashua tier of the state. So thanks for joining us today.
Thank you, Julie. And my name is Kim Vada. I'm with Kim Vada Consulting up in Lancaster, New Hampshire, and I've been working with Julie for several years now on the Business of Childcare Initiative, which is much like what she said. It's an initiative formed to provide resources, technical assistance, funding, and just information, hopefully good information, quality information about the business management side of childcare. I've worked closely with quite a few of you now, so I think you have a good sense of what that's about, and we're happy to share more information with folks who have not worked with us directly. I'll be sending some resources out at the end of the webinar. We'll include a Business of Childcare flyer, so if you are interested in knowing more, you can certainly do that and dig in. But with that, we'll just sort of move into the workshop or the webinar for this afternoon. And today we're focusing on cash flow. And what I'm hoping you leave today with is an understanding of what cash flow is. You're going to learn about the fundamentals of and best practices in cash flow management, and you're going to learn how to create a cash flow projection. And I'll mention this at the end of the webinar, but we'll provide you with some resources that will help you do that. We've got some good templates that we've created for the Business of Childcare Initiative, and we'll share those with you, and so that you can sort of dig in. If this isn't something you're doing already, you'll have some fresh tools to work with. And if you are doing cash flow forecasting already, then hopefully this will be a good refresher for you, and maybe you'll also find that tool useful. But we'll go into that more later. But this is today's workshop objectives. What's cash flow? What are the best practices in cash flow management? And how do you do cash flow forecasting? So this is sort of that chat box section. I really want you to talk to me a little bit about what you already know, because I think you already know much of what we're going to talk about. It's whether or not you're using that. So I'm going to put up some questions, and then just feel free to chat your thoughts or what you think the answer is in the chat box. So the first one is there a difference between profit and cash flow? And I'll give folks a few seconds to respond to that. And if not, I'll jump in there. But what do folks think? Is there a difference between profit and cash flow? Anyone typing there?
Not that I see.
No, here we go. Oh, I got a private response. Okay, Lisa, yes, I think. Yes, but not sure how to explain it. That's okay. It is tricky, actually. So, I mean, profit is basically what you have left over at the end of a specific period of time. Often when we do our budget for the year, and we project how much income we're going to get for the year and how much money we're going to spend, and then what our profit is going to be at the end of the year. That's profit. It could be for a year, it could be for a month. You could even look at your profit for a week, but it basically covers a specific period of time, looking at income, looking at expense, and looking at what's left. Cash flow is what you have on hand at any point in time. So if you look at your bank account today, how much cash do you have? That's cash flow. That's what's available at any point in time, basically, to pay your bills. So hopefully that makes sense to everyone. There's a difference between profit, what you expect to earn over a period of time, and cash flow, which is what you have on hand. What is a cash flow problem? So you must have some thoughts on this. Personally or professionally, we probably all have experienced cash flow problems. What do folks think a cash flow problem might be? It's in the negative. Not having cash to pay your bills. Yes, Linda. Exactly. You don't have enough cash available to cover your expenses. That's a cash flow problem. What are some causes of cash flow problems in your business? Particularly early childcare. What are causes of cash flow problems? Delayed tuition payments from Jen. Lisa, enrollment. Marquetta, customers not paying timely, so collections, definitely. Can be seasonality. Absolutely, seasonality is an issue in this business. Those are some good ones. Other ones might be that you've overextended yourself in other investments. Perhaps you've extended yourself in investments in your property or in the purchase of equipment, and that's sort of reduced your available cash flow. Allowing customers too much credit. We talked about the collections piece. That definitely comes in mind. And obviously that drop in enrollment is an issue as well. Seasonality to our year, a large unexpected expense, absolutely. So seasonality is definitely a concern. You switch over from school year to summer and then back again, so that'll interrupt your cash flow. So good. What are some of the ways in which a business could reduce negative cash flow in the short term? Let me move that a little bit so folks can see. Line of credit. Yes, Linda, line of credit. Absolutely. Marquetta, save. So you guys do know this stuff. Yep. So saving money is definitely, so having money in the bank, collecting on receivables, right? That's the first one we should always attack. Look at our receivables. Who owes me money? If things are really you're really in a cash crunch, you could call your own suppliers and talk to them about negotiating payment terms to increase your cash flow. May not be something you want to do as you do, not a routine practice, but certainly if you're in a cash crunch and you have a supplier that you have a regular relationship with, they might be amenable to a delayed payment if that's something you need to do. Obviously, definitely delaying any capital expenditures. Perhaps you were going to paint the building or purchase a new playground set, but that kind of thing might have to wait. Cutting discretionary expenses, looking at where you can save money on your sort of routine line items. And then obviously if you do things like allow overtime, you could reduce overtime or look at staff scheduling. So there are things that you can do to address a cash flow, negative cash flow. Typically in the short term, long term you'd want to solve the problem, but if you've got a short term cash flow crunch and you just need to get through that, those are some of the ways that you could think about doing that. Obviously the best ones, having some money in reserve is the way to go, but it's a challenge to get there. I know many of you have that challenge, and we'll talk about that a little bit. Oh, let me get back to the presentation. What are two benefits for a business that actively manages its cash flow? Anyone have an idea of why managing cash flow is helpful, why it's a useful practice? What would be a good reason? Forecasting for future needs, Celissa. Yes, absolutely. Avoid late fees, reduce the cost of capital. Yes. Projections for future need, be prepared for possible costs. Exactly. You can plan ahead. You can forecast what you're going to need down the line. You can plan ahead with confidence. You can make those capital expenditures because you've planned for them ahead of time. You can reduce your dependence on capital costs or financing costs. So those are all good benefits for planning, for actively managing your cash flow. Excellent. And last question, once you've prepared a cash flow projection, which of the following scenarios would be the best course to take? And so you can just write A or B. A, change or modify the numbers every 12 months, or B, adjust projections as you go along so the numbers maintain reliability. A or B? B. B, yes, B. All right. I know that seems like a Barney Rubble, but we so often will prepare a cash flow forecast and we get a snapshot of what our cash looks like. Often we do it for 12 months and then we set it aside. And so that's sort of the point of that question, is that if you do go ahead and do cash flow forecasting, make sure you use it as a tool and adjust those numbers as time goes on and things change so that you can rely on that forecast. So as I said, all or some of this already. You just may not be using that knowledge in a formal system, and that will affect your cash flow, your bottom line, because of that. So this is what today's webinar is about, is sort of helping you think about using that knowledge in a formal system. So managing cash flow, why should you care? We talked about this a little bit. Well, a business can survive for a short time without profits, and that's that monthly picture where you may have earned $10,000 in income but spent $11,000 on expenses. That's profit. You may be okay that month still because you've got $10,000 in the bank. But if you don't have ready cash available, then you're in trouble. So ready cash, how much money you have on hand, is really a primary indicator of the health of your business. And for that reason, managing the inflow and outflow of cash needs to be done. It just needs to be monitored and it needs to be managed. So there's three primary components of cash flow. And we're going to talk about cash flow components first. And the first one are the funds on hand at the beginning of any period. And so when you're doing a cash flow forecast, you want to start with how much money do I have? And you determine the period. Often people will do cash flow forecasting when they do budgeting. You'll do your annual budget for the year. And you may also do a cash flow forecast as well. For those who have a cash-based business, they can often be one and the same because you're looking at cash as it comes in and you're looking income as it comes in and expenses as they go out. If you're a nonprofit, you might do accrual-based accounting, so your budget might look a little different than your cash flow forecast. But you determine the period, and it says often we do it for a year. If you're in a really tight cash position, or if you generally run low on cash, you might want to have a cash flow forecast that's much shorter than that, maybe a month or 2 months. And at the end of the workshop, we're going to share two templates with you. One provides you a monthly cash flow forecast for a year period, and the other one does a weekly, provides you a tool for weekly cash flow forecasting for a 2-month period. So you determine the period. Another component of cash flow are the funds received and spent during that period. So you'll decide if it's a year, or you'll decide if it's a month or 2 months, whatever you decide is the period you want to monitor cash flow. Then you're going to look at what money comes in and what money goes out during that period. And then what funds are remaining at the end of the period. And that's sort of your cash flow forecast. So you're looking at, if you were doing 4 weeks of cash flow forecasting, you're going to say, this is for how much money do I have at the beginning of those 4 weeks? What money came in and what money went out on the course of those 4 weeks, and what money is available at the end of it. So I like this quote. I think it really sums up nicely. Cash flow is the lifeblood of any business, and it's imperative that you understand the inflows and outflows accordingly. So you really need to know what inflows are. Where's your money coming from? And that's the sale for you, particularly in early learning, it's the sale of your service. Maybe you sell a product or two, but most likely you're really just selling your service, which is childcare or early learning. That's your primary inflow of cash. Short-term credit is another type of inflow. Some of you may have set up a line of credit. That's not a bad thing to do when you're a small business. So that's something to think about. A personal loan, that might be another type of short-term credit. Current accounts or short-term deposits. So if you have money in the bank, if you have savings, or you might have short-term certificates of deposits. If you've got money in the bank, that can provide an inflow or be an inflow. It should be ready cash. Asset sales. If you had anything that you could sell, that might be a form of cash. It would need to be something that can be readily sold. And then owner investments. You might invest in your business periodically, or you'd have investment vehicles that you have, whether it's a money market savings account or stocks where you earn dividend income. In today's market, interest in dividend income isn't very significant, but this is still something to keep in mind. If you had cash available and you had investments that earned interest or dividend income, that would be a source of inflow for cash. And then for some of you, you may raise money through fundraisers or grants. That is another inflow of cash. Of course, the level of certainty around those items or types of inflows can be high. You don't necessarily know if you're going to get a grant unless it's one that you've been getting very regularly for a long period of time. Then you have more certainty around it. And then obviously fundraisers, sometimes they're more successful than not. Of course, history around an event will give you some level of certainty, but there's always that little bit of unknown around grants and fundraised revenue. Cash outflows or money going out. Operating expenses, that's what it's your day-to-day. This is what you're spending to keep your business going. It's your rent, it's your food costs, it's all of those things, administrative costs that you need to cover to keep your business going. Wages and benefits, obviously you have to pay your staff. You're a very staff-driven business, you know that, and that's going to be one of the more significant outflows for early learning centers. Loan or credit card principal payments. You might have a mortgage, you might have a business loan, you may float some expenses on credit cards. So whatever you need to pay regularly for that type of financing, that's an outflow of cash from your business. Asset purchases, that's that large expenditure, computer equipment, a playground equipment, anything like that. A vehicle for transport. Asset purchases is a definite outflow of cash. And then owner withdrawals. For those of you who do own your own business and do owner withdrawals, that's certainly an outflow, and it can be a significant outflow of cash from your business. Just so folks know, if you do have questions while I'm chatting, please feel free to use the chat box. Julie will be watching it, so if I miss the question, Julie will flag me, and I'll get back to it. I'll get to it and answer your question as we go along. There's no need to wait till the end of the session. So there's a few things that are not cash flow, and that's long-term loans. If you do have a mortgage, you certainly have a mortgage payment, and that's an outflow of cash on a regular basis. But a long-term loan is not a cash flow. And that's basically the money you've received or the capital that's been forwarded to you to purchase a building or something like that, or a vehicle. Long-term deposits, if you've got money in the bank that's locked up, sometimes certificates of deposits, that type of thing, or a retirement annuity, any kind of long-term deposit would not be considered cash flow because it's not readily available. Some of these vehicles may be available to you, but often it's with significant penalties. So you wouldn't think of it as ready cash. Money owed by customers. You feel like that's cash flow, but it's really not. As though there's an expectation that customers are going to pay you, that's not a guarantee. So you wouldn't necessarily consider receivables as a cash flow. However, you should certainly be aware of your receivables and be managing them because they can positively affect cash flow. So those are sort of the components of cash flow. This is, we did what the inflows and the outflows, and then what is not cash flow. I just sort of wanted to recap that. So why manage cash inflows and outflows? One of the main reasons we need to do this is because money comes in and money goes out, but they don't do it at the same time. So it doesn't happen together. Income and expense doesn't coincide. But you always need to be in a position to pay your bills. And so you might have bills come in before you have income come in. So you really need to be able to map that out so that you're able to pay your vendors when they want to be paid. So if you're not doing that, you're going to come across times where you're just simply not able to pay your bills. So managing that, the cash inflows and outflows effectively can really help you avoid that. So basically, what you're hoping to do is speed up your inflows to get money in as quickly as possible. And that's good, cash flow management, inflow management, and slowing down the outflows. How do you manage your expenses so they are more in line with your income? So think about that as we're moving forward and we're looking at cash flow forecasting. Okay, so what we're going to do is we're going to talk about a cash flow cycle. And we're going to start with this very short, it's really 45 seconds. It's a video, it's a few minutes, but there's a short piece of it I want you to listen to. So I'm going to play that for you. And then we're going to talk about the cash flow cycle of an early learning center. So I'm going to start this. And then give me a second to get it where I want it to be. I like the name of that, Cabbage University. Cute. I think we're about right here. Okay. Hopefully you can all hear that. There we go. So really, I want to talk about, that's really the cash flow cycle. It's the amount of time it takes you to provide your service. And for that example, this person's acquiring a product, but for you, it's the amount of time it takes you to provide your service and receive payment. And that's that tuition. That is the cash flow cycle of an early childhood education center. And most often, early learning centers have a short cash flow cycle, but you still need to know what that is. And so we're going to go through that and sort of calculating what kind of questions you need to ask yourself or answer in order to calculate the cash flow cycle of an ECE center. So the first question is, how often are your services rendered? And for most of you, that's daily. I mean, you're open every day, you're there to provide the service to a family, so it's most likely daily. There might be a few different models, but we're going to assume it's daily. Do your families pay weekly, bi-weekly, or monthly? I've seen all different scenarios. I think most often it's weekly, but I've seen monthly and I've seen bi-weekly. So you have to answer that question. How do your families pay? Do they pay before services are rendered or after? And I've seen both as well. I think I've seen more before, which is, I think, great, because that's going to shorten your cash flow cycle quite a bit, but some of them actually pay after services are rendered, and that does create a cash flow cycle for you that's a little bit longer. So if your center delivers ECE services for 5 days and receives payment at the end of those 5 days, your cash flow cycle is 5 days. If your center delivers ECE services for 5 days and then bills for services at the end of 5 days and allowing 1 week for payment, if you give them 1 week payment term, your center's cash flow cycle is 12 days. So just by allowing that option of billing, invoicing, and payment terms of 1 week, you've extended your cash flow cycle 12 days. So you're going to be providing a service that you will not, potentially providing a service that you will not have been paid for 12 days, and that becomes your cash flow cycle. More recently, I've talked to centers and I've heard more and more that centers are paying for their service the week of. So they're paying on Monday for that week of service, and that's fantastic because that means you basically have a 0 days cash flow cycle. So that's the ideal. It doesn't work for everybody. Some centers are set up differently, and that's absolutely fine. You should be doing what works for your center. However, if you do see that you're having a cash flow issue, I'm going to just see if anyone's not muted. Nope, we're good. If you do see that you're having a cash flow issue, you might want to look at that, at your billing, in your payments timing. So I think that's something to be thinking about, is exactly when you're rendering the services and when you're receiving payment for those services, and sort of knowing that cash flow cycle. And we're actually going to, and I said that most EC centers have short cash flow cycles. We're going to go through.
Kim, you have a question from Lisa?
Okay. Here we go, Lisa. Yes, and so that does mess things up, Lisa, because you do. So you have a 0 cash flow cycle with your parents, with your families, but you obviously have a delayed cash flow cycle with the state, and many of you are probably in that same position. And so when you're doing your cash flow forecasting, you'd want to keep that in mind. You'd want to segregate the two. So you're looking at when you're thinking about your cash flow, you recognize the fact that you have a 0 cash flow cycle with families, but you have that delayed one with state. And so you just have to keep that in mind when you're cash flow forecasting, that you are going to have a delay in payment. So you'll have you'll have more than one cash flow cycle in your business. And most of you are probably in that situation. Exactly, and that's a good point, Linda. That can help smooth out cash flow. Obviously, it would be wonderful if we all got paid ahead of time for the work that we do, but it just doesn't work that way. Typically, you provide the work and then you send your invoice. I do that. I have clients, I work with them for a month, and then I send my bill at the end of the month. So I've got a 30-day cash flow cycle. So most of us don't work that way, where we get paid up front. So having multiple cash flow cycles can certainly help that situation. So those are good points. So how much cash flow? You can use a number of benchmarks to determine how much money you should keep in your bank account to get through tough times. We're actually going to walk through a sample, but before we do that, let's sort of just talk about what those benchmarks are. Obviously, calculate how much delivery of your service costs. What are the direct costs for your service? How much does it cost you to provide childcare? Calculate your overhead costs. The direct services are your staff, the food, anything that's sort of directly related to providing that childcare service. Could be supplies that are predicated on the number of children. Your overhead costs, those are those administrative costs, having the building, heating the building, insurance. And then calculate your total costs, and you'll be able to do that in this template we provide. And then determine what assets and credit are available to your business. And again, that's knowing what money you have on hand, and do you have a line of credit, or do you have other resources available to you to help you determine how much money you should have in the bank. And then once you make your decision that this is what you want, this is how much cash flow you want, you may have to work to get there. If you don't have that money in the bank already, then you'll have to create your target, and then you have to make a plan on getting there. And that might be paying yourself on a monthly basis or 6-month basis, whatever it is the term you decide is reasonable or works for you, to build up to that amount that you want to have on hand to get through tough times. And we're going to go through a sample here with ABC Childcare, and how much cash flow should they have on hand to deal with troubled times. So things are actually in good shape at ABC Childcare, but it's run by this woman called Nellie, and she's nervous. So she's a nervous Nellie, and she wants to know what would happen if things did go badly. What would she do? So she decides to project cash flow, assuming enrollment drops by 30%. And for her, this is sort of a worst case scenario. And she does think it could happen, though, because she's a small center, and she's got 2 families who are large and with several children enrolled, and they could relocate or cancel their services at the same time. So this is a possibility for nervous Nellie. She loves her staff. They're rock stars. They're the best thing since sliced bread. So she'd want to keep them on if the worst happened, while she figured out how to get enrollment back up or how to fix things. So she wants to be able to keep her superstars on staff. So how much money should ABC Childcare have in the bank to weather out a 30% drop in enrollment for 30 days, 60 days, and 90 days? We're going to figure that out. So she starts by looking at her monthly income, and she projects what her monthly income is going to be, assuming enrollment is at 70% of normal. And she says, okay, I'm going to assume I have no cash in the bank. She's starting at cash zero because she really wants to have a clean look at what it's going to take. So she assumes enrollment's at 70% of normal and starting cash at zero. And then you can do this in an Excel workbook. You can do it on the back of an envelope. But she sits down and she says, what's my income going to be for a month? And she looks at her parents' fees and her subsidized tuition and her food reimbursement, and she changes all of those because there's a drop in enrollment. So obviously she's not going to earn income she's not going to earn fees or tuition or food reimbursement at the rate that she would have if things were normal. So she has to adjust that income. And so she drops that all by that 30%. But she also gets miscellaneous income from parking and parking space rental, and she doesn't change that because that isn't tied to how many children she has enrolled. So her total projected income is $14,355. So now she looks at her monthly direct costs with full staff, because remember, she wants to keep all of her teaching staff. So her wages, her payroll taxes, and her benefits, none of that changes because she wants to stay fully staffed. I'm not sure what they're going to be doing when there's fewer children, but she's going to keep them busy. She does adjust her food, though, because she'll have fewer children to feed, so she should have less expense. So she adjusts the food appropriately. And so her direct costs related to the program is $11,000 approximately. And now she looks at her indirect costs. Administrative wages, for director, bookkeeper, whatnot, insurance, postage, printing, all those types of expenses, which really won't change because they're not necessarily related directly to enrollment. So she's still going to pay the rent. She's still going to have those insurance expenses and heating expenses that she had. So her indirect cost with full staff is $8,000. So she's got a total cost, direct and indirect, of $19,295. And her cash available at the end of a month with a 30% drop in enrollment is $4,940.73. So that's how much she needs to cover a month. That's how much she has left at the end of the month. I just gave you the answer to your first question. So if tuition income is at 70% of normal enrollment expectations, how much cash does Nervous Nellie need to operate at full staff? And for 30 days. So how much does she need for 30 days? I sort of gave you the answer to that, so I'll put that up. That's how much she had left after a month's income at 70% of enrollment with her expenses, her direct and indirect expenses. So that was that $14,355 minus that $19,295.73. She's going to need $49,40.73 in the bank to cover herself and keep herself fully staffed. If she needed cash for 60 days, what would she need? And I'll let you guys type that in the box if someone wants to tell me what that would be. How much would she need for 60 days? Yes, Linda, about 10,000, right? It's really multiply times 2. So it's 49,40.73 times 2. She needs 988,146. And then for 90 days, she needs $14,822. So that's what she would need to have in the bank if she wanted to basically cover all of her bases with a drop in enrollment and keep those superstar staff on hand. So I'm actually going to, so yes, so that's what she needs to have in the bank. What other costs might go up if this happened? If she really had a drop in enrollment, what other costs might go up that we didn't really look at? Anyone have an idea? Marketing, exactly. Marketing and promotion. She wants to bump up enrollment, so she needs to be out there generating enrollment. So her marketing and promotion would go up, so she might want to account for that in her forecast. And this did happen. What could you do to produce or conserve cash? Any ideas on that? What could she do to produce or conserve cash and help herself in this time? That line of credit. She had that line of credit in place. If you're a small business and you have a line of credit, that can be a useful tool. Just keep in mind that if you do that, you don't necessarily want to go to the bank looking for a line of credit when you're in a bad financial position. That's not the way to go. Yes, we pay less than the balance on credit cards. That's certainly something that you can do, Linda. Obviously it's a last resort because you've got the finance costs to associate, but it's something you might need to do. What other things? Savings. If she had some savings in the bank, obviously that would be one thing to consider. She started with 0 short-term deposits. Create a stopgap policy, and that's basically, if you keep an eye on your cash flow, decide that you're going to look at reducing expenses when it reaches a certain point. If you want to have a certain amount of cash on hand because you want to be able to cover yourself in a situation where something goes wrong, where you have a serious drop in enrollment, you might decide to say that, okay, if cash gets below this level, $5,000 or $10,000, or it might be whatever your reserve needed for 30 days, that you're going to look at reducing some expenses. Maybe you reduce some supply expenses, or you cut back on training, whatever it is. You look at what expenses you might be able to adjust for a short period of time, so that you can get back into a comfortable position with your cash flow. This activity is really about thinking about knowing your worst case scenario and planning for it. Every one of you should know, what's my worst case? If I get a drop in enrollment, how am I going to cover myself, and for how long can I do that? Your business is better than anyone, so you'll know if you've got a serious drop in enrollment, how long it typically takes you to get that back. And maybe it takes you a month, maybe it takes you 2 months normally. So you know better than anyone how much reserves you need in terms of time. If you go through the exercise of looking at what your income and expense would be if that worst case scenario happened, then you could come up with this number for yourself. So it's a pretty straightforward approach to sort of figuring out what reserves do I need to have on hand. And then you think about, okay, well, how do I create those reserves? Okay. So we're going to look at forecasting cash flow now, and we're focusing on the principles and the best practices of cash flow forecasting. And remember, feel free to ask questions as we go through the presentation. No need to wait. So cash flow should be positive. Cash flows minus outflows should equal a positive net cash flow. You want to have money in the bank at the end. It should be available. You want to have your cash in liquid assets. And so does that mean you shouldn't have some investments? That's certainly something that you can look at if you're in a position where you could put some money into an investment, a long-term CD or a money market account. Again, keeping in mind that the return on investments is very low right now, but that doesn't mean you shouldn't have in your head that investing your money can be a wise thing to do when the circumstances are right. But really, you want your cash to be liquid and available. And timely. Cash flows must be timed to come in before cash flow outflows are due. And that's sort of that piece about payment. Are you asking families to pay for services before you render them? Or are you asking them after you render them? And is that something that you could change? If you're in a tight cash flow position all the time, it's something you should certainly look at changing. But if your system's been working for you, it's been in that place for a long time, and you've got low collectibles and families pay, then you might be very comfortable with that time frame. Whatever you choose to do, to generate your positive net cash flow, have cash available, and manage the timing of payments, you need to plan. That all sort of requires planning. So that's where the sort of forecasting cash flow comes in, and what you should be doing in terms of best practices. And one best practice basically says that you should forecast for at least the next 12 months. And this is, I talked about that earlier, that's fairly standard, is when you look at your picture for the year in terms of income and expense, that you forecast cash for that same time period for 12 months. And then on a regular basis, you monitor that. So on a monthly basis, and you'll monitor cash flow. If you're in a tighter cash flow situation, if you feel like you're constantly looking for cash to pay your bills, then you definitely want to be doing something shorter than 12 months. And this is, we'll have a template for you for both of those. Cash flow forecasting enables you to plan for how much cash your business will need to support operations. And that's really how much money do I need on hand on any day to pay my bills, when cash will be needed. So it helps you forecast, to look ahead. You know that you buy supplies regularly, but you also know that you pay your insurance bill once a year. So your monthly need for cash for supplies might be low, but in June, when you pay your insurance bill for the year, your cash needs will be high because that's a much larger expense. So it lets you know what money you need to support your operations, but also when it will be needed. That's why forecasting is so useful. It helps you apply for financing if there is going to be a shortfall. As I mentioned, if you were interested in a line of credit or if you needed financing for a project, and Julie can certainly talk to you about that. Some of you may have worked with her. It takes time. It doesn't happen overnight, financing. So it's good to be able to look ahead and say, I'm going to be in a situation towards the end of the year. If I'm going to use financing in any way to help me through that situation, I've given myself the time to do that because I've looked ahead. It helps you strategically manage those excess funds. So you might be in a good cash flow position. Things are working for you. Well, what are you going to do with that money? Is it just going to sit in the checking account? Should it be in a savings account where it's earning minimal interest? Is there some other investment that you can do with those funds in terms of, improvements to the center? Whatever it is, it should help you knowing how your cash flow position down the line over the next 12 months will help you make better decisions about what to do with extra money when you have it on hand. Elements of a cash flow forecast include receipts. This is the sort of fees that you get for your services, bank interest, grants, government payments. We sort of talked about that, the inflows. What are inflows? And these are the outflows, those payments, those payroll taxes, insurance premiums, rent, mortgage, wages, office supplies, all those things that you need to purchase with the money that you take in. And the excess of receipts over payments is your net profit and loss. So this is what you're going to see in your cash flow forecast. What money comes in, what money goes out, and what's in excess, or what's my profit or my loss. And then you're also going to include an opening bank balance. That's sort of your starting balance for your cash flow forecast. And then at the end of that time period that you choose for your cash flow forecast, you're going to see the ending bank balance. And if you did have a line of credit, you could include that line of credit or other owner investments or any other financing option that you had in your cash flow forecast. So these are the elements, though, that you're going to want to include. For sure, is the receipts, the payments, the net profit and loss, the starting balance and ending balance. And if you do have any kind of financing that supports your operations, you would include that as well. Things to keep in mind as you create a cash flow forecast is to create manageable and meaningful categories. And so basically, don't create categories that match what you're doing. So if you call fees from parents, tuition payments, then that should be the line item title is tuition payments. If you get food reimbursement, then you should have food reimbursement. If you have, state subsidized tuition, that should be one of your line items. Same thing on the expenses. Make sure that your categories match what you're actually tracking for income and expense in your accounting system, or however you are tracking your income and expense, so that things match. So it's easy to look at information from one system to another. If you do an annual budget, which I hope you do, Build the cash flow forecast off of the annual budget. Again, so line items match. So you may have already created a budget for your year. That can, if you're a cash-based business, can be your template for your cash flow forecasting, and that makes it easier for your line items to match. But just keep in mind that you want to keep things as easy, make things as easy as possible for yourself.
And Kim, can I add a point?
Yes, absolutely. Yes.
That point about the line items, particularly between like private tuition payments and state subsidy, it's good to keep those separate because they can function differently, as you talked about earlier.
Yes, absolutely, because the timing of those, the cash flow cycle for those are different. Absolutely. It's an important point. It's good to reiterate that, Julie. Thank you. And be conservative. When you're doing your cash flow forecast, you're looking ahead, you're creating a picture. Don't be, you can be realistic to the penny, but it's better to actually be a little bit conservative. Lower your anticipated income and increase your anticipated expenses marginally, because if you can make the figures work by being conservative, then you can make them work if you're doing better than that. So it's good to be a little bit conservative and don't overestimate income or underestimate expense. I always, particularly if it's something you're doing for the first time, if it's a practice that you're starting, if you haven't been doing cash flow forecasting already, be conservative when you first start doing it. And always factor in a vacancy rate for enrollment. Enrollment fluctuates, and you know that. You lose families all the time for different reasons. You get new ones, you lose them. So it's going to vacillate, it's going to change. So just factor in a little bit of a wiggle room on enrollment. And that sort of just feeds into that be conservative piece. And then this is sort of feeds to Julie's piece about government reimbursements. They come in on their own schedule, so create that separate line item for those. A little bit more on creating a cash flow forecast for your EC business. Make sure you include owner's draw. If you do an owner's draw regularly for your business, then you should include that in the cash flow projections. Never borrow against payroll taxes. This is probably an obvious one for everyone, but it doesn't hurt to state it. This has burned other early learning centers before. Your business can be shut down if you are delinquent on payroll taxes. Make sure that they're included in your cash flow forecasting. It's just imperative that payments are made timely. And if you can, this is your target, you want to include reserves in your cash flow. And that's sort of, that paying your savings, your self-savings. You never know when something's going to happen. And if you can do it, if you've got the bottom line that allows you to do it, you want to create a reserve. So it's great to build that into your cash flow forecasting, to build that into your budget. Decide what your target is. We looked at how to sort of determine your target earlier. And then take your time. You may have to take your time, but do the best you can to get there so that you can have those reserves in place for when something does go wrong, whether it's a drop in enrollment or a need for a new vehicle, whatever it is. And then think ahead. Think ahead to the financial impact of upcoming changes. There might be a new program that you're considering adding, a new marketing campaign. Perhaps you've been thinking about adding a room for ages and you haven't done it, but you're finally going to do it. Maybe you see that a new center is opening up in the area and you're worried about competition. So just sort of think ahead, what's happening around you in your environment, what's happening in your center that might impact cash flow forecasting. A few more things. This is really important because when you start using a cash flow forecasting tool, you're making assumptions about, the numbers that you're using. So it's really good to make notes. Keeping track of the assumptions that you make. So if you're using a spreadsheet, you can just make little notes in the side about, if you've got a tuition number of, $11,000 a month, well, what was the enrollment at? Make a little note. That was assumed that you were at 60% enrollment or 80% enrollment. So you just make little notes on the side that that helps you keep track of what you were thinking when you created that cash flow forecast. For your schedule of rates, you might make a note that says that was the 2018 rate schedule. 10% of children on subsidy. Increased wages of 1%. So whatever assumptions you're using when you're creating your cash flow forecast, make yourself little notes in that spreadsheet somewhere, so that you'll remember that when you go back to look at it. When you're cash flow forecasting, it's a good time to evaluate costs and to think about your expenses. Are there any ways you can lower your direct or indirect costs? Renegotiate with suppliers or vendors. Think about that. It's the same when you're budgeting. It's a good time to sort of think about these relationships and your costs and whether or not you're being as efficient or effective as you can in managing expenses. And it's also a good time to evaluate your rates. Can you charge more? Are you losing enrollment because your rates aren't competitive? It's just, I think these are questions that you're probably asking yourselves all the time. Just keep in mind that you want to ask yourself these questions when you're actually sitting down and looking at doing cash flow forecasting. All right. Excuse me. So some of the reasons for cash flow problems. A couple of you mentioned this when we were talking earlier. Certainly a difficulty in collecting receivables is a primary challenge. For those of you who are able to automate collections in any way, it'd actually be interesting to hear if any of you do that and if that's improved your collections. If you allow automatic payments through credit cards or electronic payments in any way, if that's helped with collections, that's certainly one thing that we've heard helps with collections. And so if you have that experience, certainly just sort of write about that in the chat box. That'd be interesting to know. Oh, see, there we go. We use Tuition Express ProCare because that's certainly something to consider if it's an investment that you can make. Having someone dedicated to managing collections is certainly helpful. To me, this is sort of one of the primary challenges for, as you know, early learning centers in managing inflow. Cash inflow is that collection piece. Marquetta uses Brightwheel. Okay, did you see improvement in collections when you started allowing sort of automated payments? Let's see if anyone can respond to that. Linda, yes. Okay, yeah, so both of you did. That's great. Celissa, absolutely, yes. So certainly something to think about if you're not doing it already. And we've heard the same thing from other folks when we talk to them. Automated systems really, really help. So if you're not doing that, think about that type of investment, particularly if you're in a position to make that type of investment now. But if you're struggling with cash flow, then this might be one way to institute a fix that will, contribute to addressing that. So collecting fees is the most important cash flow management task for the ECE Center. You guys know that. Seasonality of the business, obviously that's one of the reasons that came up earlier. That's definitely a reason for cash flow problems in an early learning center. Your enrollment changes based on the time of year. You can, plan for these changes. So when you're doing your cash flow forecast, it should certainly take into account that your enrollment's going to shift. And so that might mean that your summer is either in a better cash position in the summer or a worse cash position in the summer. It might depend on what you do for summer programming. But there should definitely be a shift in your inflow and your outflow, particularly if you make staffing changes, of cash over that period. So when you're doing your cash flow forecast, January, February, March, April, every month shouldn't look the same. It should really be driven. Summers are stressful, Linda says. Yes, I've heard that because I've tried working with quite a few of you, and this is a really busy time, particularly during that transition period. But every month should not look the same. Your cash flow forecast should be, each month should look differently based on what's happening at that point in time with what you expect to happen with your enrollment. So unexpected variations in revenue, that sort of goes back to some of the stuff we said earlier, but local business shuts down, so families move away, a competitor opens up, that you may not necessarily be able to plan for, but if a local business is shutting down, you might be able to look ahead if you've got some knowledge of that. So think about the unexpected variations in revenue that you can plan for, and keep those in mind. Other reasons, if you have a policy on how payments are made to suppliers, basically, do you monitor your invoice terms or pay bills upon receipt? Have you negotiated terms with vendors? For most of us, it's nice when the bill comes. You have a time of month when you pay the bills and you're able to pay them. That's fantastic if you can do that. If you are challenged with cash flow or with having cash on hand, you might want to more proactively manage your payments of bills and monitor payment cycles, and so you can pay bills on time, absolutely on time, but in a way that helps you have more cash in hand on a daily basis. So think about that. That is one avenue that you can take to managing cash flow, is being aware of your payment terms with your suppliers and also negotiating terms with them. Like I said, particularly if you've got a long-standing relationship, this is an area where you can approach your vendor and say, it would really help me to pay this bill on the 15th of the month rather than the 30th of the month. Maybe you're better in the middle of the month with cash flow than you are at the end. So think about that. Bulk rates, obviously. Again, a long-standing relationship, just pick up the phone, call your vendor and say, we've been together for a long time. I really would, I'm thinking of, putting out a request for proposals for a new contract. Is there anything you can do about my rate? So think about how you can manage to reduce your expenses or manage your bill payment in a way that increases cash flow.
And Kim, this might be a good place. I've not been paid to do a plug for shared services, but folks should just be aware, and Celissa is on board here. Through Early Learning New Hampshire, the Shared Services Alliance, some folks have found savings on their utility bills and other costs by being a member of the Shared Services Alliance.
Absolutely.
Find that information at Early Learning New Hampshire.
Yeah, it's on my next slide, Julie.
Oh, sorry.
No, that's good. You preempted me, so she'll get 2 plugs because I'll mention it again.
My bad.
No, it's not at all. I think it's important to state it, and I think that is one of the things that comes under, payments to suppliers. Are there other ways to get those supplies other than just negotiating with vendors? And that's, consolidating purchasing, and that can be through bulk purchasing or partnering with others. So it's a good point. It will come up. So that's a good one. I made, it's not under this one. It's when I talk about methods. So to improve cash flow, but it's in there. But capital projects and purchases, do you plan ahead for these? That leads back to that building up reserves. If you need to purchase a new piece of equipment, do you just go out and do you buy it, or do you plan for it and do you build up the reserves that you need to purchase it? If you buy on credit, you need to work that credit payment then into your cash flow. Try and time large purchases during peak cash flow periods so that you reduce your financing costs. If you do have to use financing, maybe you'll be able to use less financing. So again, sort of all of this is feeding into that idea that you want to be thinking ahead and you want to be planning. In order to map these things out on a piece of paper, you need to be thinking about it and you need to be planning, planning ahead and looking ahead. So methods for improving cash flow continued here. Determine what needs to be monitored in your business. Know your key performance indicators, and in your world, the most important is enrollment, and we kind of know that. That really drives everything else. Obviously, the other things, the flip side of enrollment is the more students you have, the more staff you need. So personnel costs, it's very typical, I think, when I look at your businesses and your financials to see that personnel costs are up in that, 70, 80% of your costs are around personnel. Food costs, obviously directly linked to enrollment. So that's something that you'd want to watch, and that's a cost that could be managed through bulk purchasing, shared purchasing. Fuel costs, there's some unpredictability around fuel costs, and they're often a significant contributor to your budget. So these are just some of the key performance indicators that you need to be thinking about and monitoring more closely when you're doing cash flow forecasting. Receivables, again, that's that collection piece. Are we getting our money in a timely way? Payables, are we managing our bills effectively so that we're increasing cash flow? And then, negotiating that relationship with suppliers. So these are sort of those key performance indicators, those key items that you want to be really focused on and thinking about in cash flow forecasting. When you do cash flow forecasting, you've got that sort of workbook that you're plugging in your numbers to look ahead. You want to make sure that you're inputting the actuals and then you're comparing them to your plan. And that's that sort of piece where you said, okay, I've said what I think cash flow is going to look like for the year. Now, what actually happened? And then go ahead and actually plug in those actual numbers. And so if January's come and gone, you can say, okay, well, actually, what actually happened in January? If you've got a cash flow forecast for 12 months and it's broken out by month, you plug in your January numbers, it should change what's happening the rest of the year. So it should shift your forecast. And then you should be able to look and say, oh, well, February in the rest of the year is looking better now because we made more money in January than we thought we did, or we took in more income, or maybe it's the reverse and you spent more than you thought you would. And so things aren't looking as rosy. So make sure that you're actually comparing what actually happened to your plan. And, typically you do that monthly. But if you are in a more worrisome cash flow position, then you would do it weekly. Identify the variances. Take, basically what did change. Did enrollment go up or down? Did fuel costs go up or down? What were the actual things that contributed to the change in that month of January? Take corrective action as needed. Do you need to, do a marketing blitz because you've lost students? Do you need to renegotiate a contract with the fuel supplier because fuel costs went up so high? What changes do you need to make? And then consider shared resources. This is a point that Julie was making. Their ECE shared resources is actually, Celissa, can I? I can't because she's muted. I can't. I'm going to unmute you for a second, Celissa, and let you. Oh, I don't know who you are. I can't because you're Kim Vada. Everyone's Kim Vada. All right. Well, then I'll say.
Can you tell me, Kim, if you can hear me?
I can. Yes. Okay, great. So I'm going to let you speak about EC shared resources.
Sure. I was able to unmute myself on my own computer. So, yeah, the CELA website, the State Early Learning Alliance of New Hampshire, we have a website where there are a lot of opportunities to sort of pool together to purchase things like heating, fuel, and electricity. And then another thing that happens through collaborating between member programs is that they will schedule trainings that they come together and share the cost of that professional development. And then we also are able to secure grant funding at times so that additional training can be offered, including community college classes at a fraction of the cost because of the coming together to share those costs.
Wonderful. So for those of you who are familiar with EC shared resources, you know that it's out there. You can find information out at the CELA website if you want more information about it and to check it out. But it's certainly an avenue you should be considering if you're looking to save cash and improve. And the website URL. Do you want to type that in for us, Alyssa, into the chat box? You probably know it off the top of your head. Oh, there you go. Wonderful. Thank you. Okay. So CELANewHampshireMembers.org, check that out, everyone, for more information about shared resources. And one of the things that CELA mentioned was collaborative trainings. This is certainly an avenue for that. You could also talk to your peers and folks that you work with. And to see if there's something that you can do together. If you've got, I know there are peer network groups throughout the state, so you could look at doing collaborative trainings to save money. Outsourcing admin functions, thinking about that. If there are administrative functions that you could outsource that would, either, they may cost you more money on the front end, perhaps outsourcing some bookkeeping chance, but it may give you more time to focus on some of the other drivers, like increasing enrollment, improving collections. If there are pieces of your operations that are affecting cash flow in a negative way that need attention, but you can't give that attention because you're too focused on administrative functions. So think about outsourcing admin functions. And then obviously, bulk purchasing or, collaborative buying of things like office of fruit supplies, insurance programs, and that type of thing, like Celissa was mentioning. So consider shared resources and other approaches. You can also improve cash flow by increasing borrowing or putting more money into the business. This can be acceptable for coping with short-term downturns or fund growth. Like I was just talking about, if you needed to invest your time in improving collections or in improving enrollment, an investment in an outsourced administrative function might make sense. It may increase your expenses in the short term. I mean, it might increase your expenses, that'll hit the bottom line, but in the long term, it'll be a good investment because you'll increase enrollment and reduce collections. So you sort of think about it that way. So like a line of credit might make sense for a short-term problem, but you basically don't want to think of financing as a routine cash management practice, basically. Know that it's there as an option and think about when it makes sense, but don't necessarily make it your routine go-to because getting money costs money. There's, financing has a cost associated with it, whether it's credit card debt or a line of credit or a loan. There are costs associated with that. So keep that in mind. Go ahead.
That's what we say here, Kim, that debt can't fix a revenue problem. There are times when debt is appropriate for your business and times when it's not. So that's a good point.
Great. Thanks, Julie. Okay. So everyone should forecast their cash flow. And what I'm going to do is provide you with some resources so that you can do that. And I'm just going to show you these resources, though, so you'll have a sense of what I'm talking about and looking at. The first is we're going to provide you with 2 templates, and I'm just going to tell you what I'm providing you, then I'll jump to them. And the first is we call the BCCO cash flow template modified, and this is, I say it's modified because this template is from First Children's Finance, and if anyone who's gone to any of my workshops, listened to any of my spiels, I've mentioned First Children's Finance because a lot of the materials I share with you is from that website, and I will actually type it in here so you have it because I don't think I put it on the the later slide when I mentioned resources, which I should have. There we go. firstchildrensfinance.org. They have a template, and I just happened to modify it a little bit because I wanted to make some modifications I thought would work a little bit better. So that's the monthly one that I'm going to show you, and then I did one that's weekly, and that's for those who want to monitor cash flow more closely. And then the third resource I'm going to share with you, and I'm going to show you all of these, is an interactive cash flow activity that I want you to go back, and I will really hope you'll play with it. I do this activity in the workshop format. It's just too complicated to do it in a webinar format, but I really want you to have it, and I hope you'll go back and play with it, and I'll show you that as well. So first is the monthly cash flow template. This should hopefully open up on my computer, and I might have to reshare my screen with you. I do. So let me go and do that. Okay. Can everyone see this Excel spreadsheet? Just a couple of you type yes, and that'll be great, or 1. Julie, can you see it? There we go.
I can see it.
Okay, great. Wonderful. So this is the monthly cash flow. And so you'll see cells highlighted in blue. Those are the ones you type in. So you'll type in your business name and your starting date. You might decide that it's January 1st. Of course, I'm not going to be able to type now because I need to. Okay, there we go. You'll put in the date right there. And this is where you're going to go ahead and you're going to look at your cash flow for the year. So you're going to put in your parent fees, your child care assistance, other fees, and you're going to do it for each month. You're going to put in the months. Maybe you decided to start on June. So this is really June 1st right here. So this is why these fields are there for you to enter and modify as you see fit. And then there's the same thing here for expenses. This is the number of payrolls per month. Maybe you do 4 payrolls. Maybe you do 2. This is where you put in that information. And then you'll go in and you'll put in your expenses. You know, obviously change these. If you don't do program food, maybe you do something else. Maybe it's cleaning supplies. So you can change that to cleaning supplies. You know, you'll figure this out. But this really is just a template. It's generic. So you have to modify it to work with your business. But this is a great basic template to get you started on a cash flow forecast. And you'll see right here, this is where you put in your beginning cash. So if you had $3,000 in the bank, you would put $3,000 in the bank, and that carries over because until you spend it, that money's there. And then you'll see how this works. If I got $10,000 in fees or $100,000 in fees, that carries over as well. And if I spent, you know, $90,000 of my money, you'll see that helps you. That's what a cash flow forecast does. It's carrying over the basically net of your income and expense, of the money coming in and the money going out on a monthly basis to the next month. And so at the end of the year, you'll be able to see and say, oh, okay, I had $13,000. So this is the monthly cash flow forecast template. Some of you will recognize this because this is a modified form of what I may have created for you. This was sort of the starting point of what I created for quite a few centers now through the technical assistance program. So it might look a little bit familiar to you. And so the next one, I have to go back now to the presentation. There we go. Is the weekly one. And give me a second. I have to reshare my screen. And there it is. Okay. Here we go. And so this is really pretty much the same thing, except you'll see it doesn't, it's not based on months. It's week 1 through week 8. So you'll do the same thing, business name, you'll do the start date. You know, it says maybe it's July 1st, whatever that is. And then you're going to do your week 1 through 8, and you're going to do the exact same thing. What income do you expect coming in? What expenses do you expect to go out? And you're going to get yourself, and you'll do that for each week. You're basically looking ahead and you're projecting, and then you're going to see if you've got, you know, positive or negative cash flow after you put in all of your data. So this is the kind of, this is what you would use if you're typically more in a cash crunch, or you just want to keep a closer eye on cash. You really want a better sense of your weekly cycle for cash. You know, is it week 3 that things look good in a month, or is it week 2? If you want to have a closer look at cash, you know, something more frequently than a month, you could use this tool. And what you're going to do at the end of each week is, once you put in all your information, you've got your 8-week forecast. At the end of week 1, you're actually going to go in and you're going to say, okay, what actually happened? And that's when you're going to go ahead. So if you had budgeted, you know, $1,000, oh, sorry, here we go, $1,000 in parent fees for that week, but you only earned $800, and you did that for every week, the whole 8 weeks, you're going to get $1,000. But in week 1, you actually only got $850. That's what you're going to do at that end of week 1. And then at the end of week 2, you're going to say, well, I actually did get my $1,000. But in the end of week 3, I only got, you know, $765. And so that's the end of each week, you're going to actually put in what actually happened. And so you're watching your cash flow forecast shift as the week progresses. And again, that's why this is useful. If you're in a really tight cash position, you can be kind of monitoring it more closely. But in the year-long one, it gives you that larger scale picture. And here we go.
And Kim, you have a question from Linda?
Yes, I see that. I think it depends, Linda. You certainly can. I think if you want to have a clearer sense on how each sector is driving cash flow or contributing to cash flow, then you might break out each one. You know, if overall you just want a sense of, you know, parent fees or tuition, then you could keep it capsulated. I mean, I think having more information can be helpful. But certainly, if you want to know how each of those classrooms is contributing, you know, what their sort of how they drive cash flow, then you would break it out. It's just going to give you more information, more detailed information. It just requires you to, you know, add a row or not. Absolutely, and that's a good point. It does, particularly if you're going to be sharing this information with staff. It's a great way to do that, to sort of break that out and say, show them, which rooms are performing, and when you've got that sort of line item information, you can provide more details and better information to staff, and just when you're looking at your own finances, it can be more helpful to break it out too. It depends on how detailed you want to get and how much of a quick and dirty you want. Do you just really want to get a quick answer on cash flow, or if you're going to map it out for the year, then being more detailed can certainly be more helpful. So it's a good question. So that's that spreadsheet. So I'm going to send both of these to you, and then here is the interactive cash flow activity. And so, I always have to remember to reshare my screen. Where's that? That is right here. Okay. Okay, so this is a Word document. And Julie, can you see this?
I can, yes.
Okay, I assume if you can see it, everyone else can see it. This is, hold on 1 second, everyone. I don't know if it was my husband or my cats who were just opening the door. Okay. So this is the Managing Cash Flow for Smarter Financial Decision Making. This is an interactive cash flow activity. And what I'm going to do is send you a spreadsheet, and I'll show you that in a second. And you're going to save that spreadsheet to your own system. And then you're going to, you'll go through these instructions on how to do that. And then you'll familiarize yourself with the spreadsheet. It's similar to what we were looking at, except there's already numbers in there. It's basically, this is ABC Childcare again, although, a little different. And it's a 12-month cash flow projection for ABC Childcare. And so you're going to see income and expenses in all the rows, and we'll look at that. But the real neat thing about this is I give you 5 different scenarios that you go through to sort of adjust her cash flow projection. And you basically decide, what you want to do. Do you want to give staff a pay raise? And if you decide to do that, then you've got to increase your payroll for each month. If you don't do anything, enrollment goes down for 3 months because staff are demoralized. Do you finance the pay raise by cutting professional development budget? Whatever it is you decide, you make the decisions for each scenario. And it's really interesting to watch. And the decisions compound. You can't make a decision in February and then change your mind in March. Once you've increased salaries are increased. And so then you go on to March and you make a decision based on what you're going to do about fuel costs. And then once you make that decision, you move on to June, and you've got to make another decision about your operations, and it's related to tuition increase. And so you basically go through each of these scenarios. At the end, you can choose to go on a vacation if you like, and see how that impacts the cash flow forecast. So I'm hoping, I'm going to send this to each of you, that you'll take the time. It doesn't take forever. It's not a long activity, but I think it's a really useful activity, particularly if you've never done cash flow forecasting, to get a sense of how powerful it can be, how useful it can be, and how it works. So I'm going to send you that, and I'm going to send you that along with the workbook. And let me share my screen so you can see what that looks like. And this is it. So you'll see this is ABC Childcare, and this is her 12-month cash flow forecast. And she's, her closing balance at the end of the year is going to be $16,000. And you're going to go through using those different scenarios and make those adjustments, based on the decisions that you make. And you can go back and you can make different decisions. You could try it once, just save yourself a clean sheet. I'm going to send it to you so you'll have one. And you could decide to give your staff raises in February the first time. You go through all the scenarios, and the second time maybe you decide not to. So you can play with it multiple times if you like. But hopefully you'll go through that activity, because I think, again, it can be really useful. And I'm going to go back now to the presentation. Here we go. New share. Here we go. Okay. And then I will also send you a PDF of the PowerPoint presentation. So just some takeaways for today. Cash flow should be planned and managed. Hopefully you've appreciated or developed an appreciation for that and why that's important. More businesses fail because of poor cash flow than because of poor profit. And that's really understanding that difference. It's not whether or not you made money at the end of the year when you close the books, it's whether or not you could pay your bills on time. Let me go back. Comparing your actual financial results to your cash flow projections every month and noting the variance is extremely important. And that really is around if you create a cash flow report, don't bother creating a cash flow forecast if you're not going to use it, because then it's just going to become another spreadsheet in a file buried on your computer. So hopefully if you create it, you're going to use it, because that's really the only way it's useful to you. Monitoring cash flow will help you make effective financial management decisions. And, I think that you'll see that in practice for those of you who are doing it. Hopefully that is true for you, and feel free to chime in the chat box if this is something you've been doing and you find it to be useful. But it really does help you look ahead and make smarter financial decisions. And hopefully you'll see that once you start practicing it. It helps keep your business on track. Particularly when things happen that you don't have any control over. And knowing that you've got some reserves in place can be really powerful in helping you make decisions that are more smart, are smart and more thoughtful. So, keeping that in mind when you're doing cash flow forecasting is really important, and why it's important if you're able to do it, to build up a reserve. I did have First Children's Finance there. So these are the resources that sort of go-to resources for cash flow. If you want more information, most of you have heard me mention both of these before. It's the First Children's Finance website. I'm sending you a template that's been modified from the one that they have on their website. And then the Bottom Line for Children's Programs, that's that book by Gwen Morgan that I just love. And pages 73 to 77, if you have that book, has a simplified template that separates fixed costs out from variable costs. And I think that's a useful resource as well.
And so I was just going to say that book, I believe, is available through Griffin Press, and maybe Amazon as well.
Yeah, it's definitely available on Amazon, and yes, it's available through both, but you can easily find it definitely on Amazon. It's nice to buy it directly from the press publisher if you can. It's around $20 usually. So we are going to send you a webinar evaluation as well. I'll email that with the resources and your attendance certificate. But if there are any questions for me, I would love to take them. We ended in 90 minutes rather than 2 hours, which is good. It gives you a little extra time today. So, questions?
Kim, do we have email addresses for everyone given?
We do.
But I'm not sure we have everyone identified who's on, do we?
Well, I think I'll ask, if folks can type their name in one more time in the chat box, I'll be able to save the chat so that I know that you're here. But we do have their email addresses, because I did see the registration list. I don't know why it's showing up like this, but
okay.
Because I emailed everyone this morning, but I don't know exactly who came, other than I have most folks. So if you could type your name in one more time, that would be great. And okay, thank you. So Salissa's gonna send us flyers, SELA flyers, and so I'll send them to the webinar participants. And thank you, Carrie, Jen, Marquetta, Linda. I know Lisa was here. Yeah, I'll go through it, Julie. I think I've got Marquetta. I think I do have everyone based on who I'm seeing here.
You got email for everyone, okay.
I definitely have an email for everyone. It's just a matter of whether or not I know exactly who's here, but I'll figure that out. Because I think we've got everyone here. So we've got Linda, 1, 2, 3, 4, 5. I think we've captured everyone because it's 7 people.
Great.
Yeah. So I'll stay on here for another minute or so. Folks have questions, but otherwise I thank you for attending. I will send you an email with those resources as soon as we get the certificates put together. So this afternoon or tomorrow.
Thanks, everyone.
Thank you. I think maybe I got a couple folks who.
Yeah, you see Crystal Murphy there?
Yes. Yep. Yeah, I've got Marquetta, Celissa, Carrie, Crystal, Jen, Week. So 1, 2, 3, 4, 5, 6, 7. Yep. Because there was 9 of us.
Yeah, that's what I have, 7, yeah.
Yeah, so Marquetta, Celissa, Carrie French, Lisa Lashway, Linda Degler, Crystal Murphy, and Jen Weeks.
Yep, got it.
Okay, so I think what I'll do is that she may have stepped away though, so I'm gonna end that. All right. Okay, so I think it's just us now.
Okay.
So how are you doing?
Okay, how are you doing?
I'm good. So hopefully that went well. It's so
I
hard.
think it did. I just, again, wish we had more.
I know. I had we had 12. Yeah, we had 2 more over the last 24 hours. Yeah, I know we sent it statewide this time.
I know. And I don't think early learning, I didn't get anything from early learning through our request to them, so I don't think they sent it out.
Oh, because I sent it too.
But I didn't see it. Usually their emails come,
Oh,
I
okay.
didn't see anything.
Oh, okay.
So I don't know.
Yeah, that's too bad.
Yeah, that is. Because that was, would be a good, but again, it was pretty widely circulated.
Yeah.
No, I think that was great.
Okay, good. Yeah, I went through it, and the 90 minutes was good.
Yeah, no, just right.
Yeah, the workshop was longer, but the workshop was very hands-on.
Yeah.
They did quite a bit actually. There was one other activity that I would have liked to have them do, but it didn't make sense. Some of it's too challenging with webinar. So
to do it this way, yeah. And what program is Linda Degler with?
I don't know. I have to look that up because I'm like,
Okay.
who is she?
Yeah.
I feel like I know her, and
that's a new name to me. So
yeah, no, I agree. I think we've seen her before at something else.
Okay.
I'll look it up and I'll let you know. So I think that I can't remember if I have the template for the certificates, or do you have the template?
I have that, so I'll do that and send them to you, or do you? How would you like to do that?
Yeah, why don't you send them to me? Yeah, send them to me, and I'll send it with the materials.
Okay.
But I'll type up the names, the official names now, and email those to you, so you'll have them.
Okay, great.
All right. So otherwise, I think I'm not sharing my screen anymore, but I think you can still hear me.
I can.
Can you still hear me? Okay.
Yes.
Okay. I'm just because I was going to go check my email, because I think you sent me an email yesterday. No.
About to work through our extended outreach.
Yes. Here we go. Julie, where's Julie? Okay. Okay. So I guess that's good. So we can go ahead and do outreach with these folks. So I will get in touch with Great Bay Kids and Country Club for Kids. And then that's really sad news about Karen at TCP.
I know, it really is.
I will reach out to her. I've been meaning to. Actually, it's been on my list to sort of just check in and see how they're doing. So I will reach out to her and see what's going on.
Yeah, and the last I knew from being there at their event, she shared with me that she had informed the board that she was leaving. But I also talked to a board member who was kind of hoping to convince her to stay. So
okay.
I don't know where that ended up. So it'd be good, for you to see if she's still there, check in with her, and
okay.
And if she's leaving, to get us